Good morning and welcome to Energy Management Institute's What's Up Monday. I'm Dominick Chirichella and I will be presenting comments based on the week of January 22nd. Hopefully you'll enjoy them. You can contact me. My email address is shown below at www.emi.org. If you have any questions or comments, I'd love to hear from you. So with that, let's get started. It's an interesting week coming up. Certainly, it starts with the U.S. government shutdown. The government shut down on Friday when they failed to come up with a budget agreement. They're at a bit of an impasse. It's Monday morning now as I'm preparing this, and there is a meeting or a vote scheduled for around noon or 1 o'clock Eastern Time today. To see if they can get the government moving for the next 3 weeks. And I guess the problem is just going to continue to get kicked down the road here a bit and so on and so forth. As far as oil data is concerned, the DOE mentioned last week that since they get funded for several years forward, it didn't seem like they were going to be in a situation where they had to furlough any employees. So based on those comments, I am of the assumption that both the EIA oil inventory report will be released on Thursday morning at 10:30 a.m. Eastern Time, and on Wednesday morning at 10:30 a.m. Eastern Time, and the natural gas report will be released at 10:30 a.m. On Thursday. So for now, we'll have to watch and see what that happens. There's probably going to be other areas that are going to be impacted by the government shutdown insofar as financial data that may or may not be hitting the media airwaves this week, GDP estimates and a few other things that could be market moving events or market moving from the perspective that they could have an impact on equities and the US dollar. The market is still digesting the IEA, the International Energy Agency's forecast that was released late last week. And this forecast was really overall bearish. They showed a higher forecast for production of U.S. crude oil, and they basically did not show a corresponding increase in the growth of demand. In essence, and in a nutshell, the report basically is suggesting that demand might not continue to outstrip supply as we work our way down the line in 2018. I'll talk a little bit more about this in a later slide. I will go through the weekly oil inventory snapshot. It's going to be another mixed week. We'll go through the details here in a few minutes, as well as talking a little bit about the OPEC production cut and the implications it's having on the oil complex today and what may happen as we move forward down the road, especially if, in fact, this somewhat bearish IEA projection for 2018 actually turns out to be accurate. I don't mean the projection being accurate. I mean the actuals turning out to be in sync with what the projection is. We're going to talk a little bit about the daily short-term temperature forecast, not overly winter-like, and as such, we may see a little further weakening in the heating fuels complex as far as oil is concerned, for heating oil and for propane. The direction of the dollar, we'll talk a little bit about that. It's been declining due to uncertainty associated with the U.S. government cutback, and the overall correlations between the direction of the U.S. dollar and crude oil has been pretty decent of late, and we'll look at a chart and talk a little bit about that, and we'll touch on the never-ending geopolitical events, especially those events in the Middle East. So where are we? As of around 7 o'clock this morning, oil is trading either side of unchanged. The March Brent WTI spread, which is the spot Brent WTI spread, is also around the unchanged level. Feb gas oil is up a little bit. Ultra low sulfur diesel is down a little bit, and gasoline RBOB is up a little bit. Natural gas in the spot position, the February contract is starting the week slightly higher, although the March and April contract is not quite following suit right now, as we're anticipating some warmer weather. On the external instruments, treasuries are down a little bit, suggesting interest rates a little bit higher. The Dow futures are starting out the day, the U.S. session lower, as is the U.S. dollar index, principally being driven by what's going on with the government shutdown here in the United States. If we look at a little bit more detailed of a snapshot, we can see on the oil complex, the crude oil markets are still trading around the average for the year so far. Granted, it's a new year. We've only had a little over 3 weeks of trading so far, and it's trading a tad above the forward curve, the 12-month average forward curve, putting it in a slight backwardation, and it is still trading above the 2017 average along the way. We see a similar thing or a similar relationship with the oil products, as well as the crack spreads and the relationships between both gasoline and heating oil. Nat gas is also trading above its 1-year average, average for this year, as well as above the 12-month forward curve. So let's look at what we see on the charts right now. This is the spot WTI contract that's going to expire later this week on the 26th, and March will take over that spot. And we could see that the market has been in a bit of an uptrend since we bottomed out in early to mid December, and prices have been going up until the last week or so, where we saw Brent actually trade above the $70 a barrel level, and WTI on an intraday basis actually hit a high of $65 a barrel, and now we're kind of retracing a little bit. Overall, the market remains within the linear regression channel. It's still safe to call it a medium-term uptrend, but we are starting to see some of the technical indicators maybe pointing a bit lower for prices here in the very short term. Let's look at the March slots. This is going to be the spot March contract here by the 26th, starting on the 27th, and looking at that in conjunction with the spot March Brent contract. Similar, they both bottom someplace in the first half of December, have been in a medium-term uptrend, but they're both starting to look like they're having a little bit of a struggle regaining some of that upside momentum. So yes, the medium-term uptrend still looks higher, but the market sentiment seems to be more uncertain. The upside momentum has certainly eased, as we see from some of the technical indicators pointing to lower prices here in the short term. The March Brent WTI spread has kind of been in a bit of a sinusoidal movement. We're on a down leg right now and looking at support for the March TI spread, Brent TI spread of around $5 a barrel. We're certainly well off the high above $6 a barrel hit towards the end of December. Overall, the spread is still wide enough to continue to suggest that crude will continue to be exported from the United States. I believe last week's number was around 1.2 million barrels a day, or last week's report, which was for the week ending January 12th, was around 1.2 million barrels a day. And over the last 6 months or so, we've been going through this range of anywhere from about a million to a million and a half, and a couple of weeks we hit a high of close to 2 million barrels a day. So spreads on the downside. Why is the spread on the downside? Simply put, U.S. crude oil inventories are coming down. Cushing inventories are actually now down to well below the 5-year average. Remember, the goal of OPEC is to get global inventories down to the 5-year average. WTI crude oil has been in a very, very strong destocking pattern, driven by several factors, and that's kind of shoring up the WTI portion of the spread, whereas the Brent portion of the spread is still being driven by the macro OPEC cuts, which is having an impact on the international markets, and also the evolving geopolitical events that are transpiring around the world, especially from the Middle East. On the product side in the United States, the RBOB contract remains in a nice uptrend here. We're heading into the next big event. Will be the transitioning from winter grade gasoline to summer grade gasoline as the market moves into the spring, late winter, early spring refinery maintenance season. So we're still seeing refinery or RBOB gasoline holding right along, in fact, right along that linear regression line, and right in the center of the linear regression upward channel here. The technicals are still mostly positive in suggesting higher prices. On the other hand, on the diesel side, what we're looking at, much more in sync with what's going on the crude oil side. The market is losing its upside momentum. It's getting ready to test the lower support channel of the linear regression model. The technicals are suggesting lower prices, and the winter weather is not cooperating. So we're not seeing an overwhelming amount of very, very, very cold Arctic air heading towards the main heating oil part or heating oil market of the United States, which is principally the east coast of the United States. In fact, as we'll see in the chart here soon, the short-term temperature forecasts are a little bit biased to the bearish side at the moment. So with the inventories, as I said, I expect the inventories to hit the media airways on Wednesday morning at 10:30 a.m. Eastern Time. I'm projecting crude oil, another pretty big decline in crude oil, about 3.6 million barrels, a build in gasoline, as demand for gasoline is certainly at the lower end of its annual demand curve due to the winter season, and a little bit of a draw in distillate from modestly winter-like weather over the last week. Refinery run rates are probably going to come down again here, about another 0.9%. I mean, we look at these inventory numbers. I mean, overall, compared to last year, very positive in that we're down across the board: crude oil, gasoline, distillate fuel, and compared to the 5-year average, distillate is below it, gasoline is approaching it, and crude oil is not too far away. So just looking at U.S., which is a major portion of the global oil inventory picture, OPEC's meeting their objectives. It's getting where it needs to go. And this is happening in the United States at the same time as U.S. crude oil production is continuing to rise. And we'll chat about that here in a moment. So what are the two main fundamental charts that I'd like to look at today? And there's so many we can look at, but just picking two. And it's kind of a half empty, half full type of a slide here. On the left-hand side, we look at total U.S. crude oil production, which is continuing to soar. We are really getting close to not only hitting the 10 million barrel a day, and this is crude oil production. This doesn't include liquids, and we're getting close to hitting that 10 million barrel and probably exceeding it, which will put U.S. crude oil production above the highs hit back in the 1970 levels. So this is a tremendous accomplishment, and all signs are suggesting that the upward trend in crude oil production is going to continue. Big negative for OPEC. Certainly not a chart that OPEC wants to see. Not a chart that, if you were looking at this chart and nothing else, not a chart that's going to support 70, 80, $90 a barrel crude oil here in the short to medium term. On the other hand, we look at total combined inventories in the United States of combined crude oil and product inventories. And what do we see here? It's just the opposite picture. In spite of crude oil inventory production going up, total inventories are going down. And yes, it's a combination of crude and products, but by any other name, it's oil. And oil inventories are going down. And we can see now we are not that far away here in the United States from hitting that 5-year average, OPEC's objective. So on one hand, OPEC looks at the slide on the left and not overly excited. On the other hand, at least for today, they look at the slide on the right and get a lot more encouraged as to what's going on. So they're encouraged that it's working, but what the slide on the left is telling them is that they got more work to do. They got some more very difficult decisions that they're going to have to make as time moves on, and we'll talk about that here in a short period of time. So when I look at this fundamental, these two fundamental charts of the week, I'd say bearish on the left, bullish on the right. Kind of overall, I would still say somewhat positive in the short term because I would expect the destocking trend to continue between for the total combined stocks here in the United States. So let's just kind of capitalize. This happened to be a slide that was chart that was in Reuters. And it takes the three main forecasters, OPEC, IEA, and EIA. They each come out with their monthly forecast. The IEA finished up the January cycle, and it's quite interesting to look at how those forecasts have changed for the last 3 months, November, December, and January. And what we see here is a bit of a bearish slide in that all three forecasts have been kind of upping the supply and demand balance, meaning the surplus side of the equation is kind of starting to work its way into the mix. So conclusion number one that we get from this particular slide is that the forecasts are not nearly as bullish today as they were back in November. The second element we get from this particular slide is that the OPEC projections remain way more optimistic than both the EIA and the IEA forecast. And overall, when we put the three forecasts together and just simply average them out, we're looking at not a big surplus, but a surplus, albeit across 2018, which would mean that the destocking pattern of inventories is kind of going to slow, if not switch gears here a little bit. Big question mark for OPEC, and basically kind of says that OPEC's got a decision to make here, and we'll chat about that in a minute. So overall, this is a bit of a bearish look. It's kind of worked its way around the markets late last week, It's kind of supported pushing prices down. Or as I said before, oil prices are kind of trading either side of unchanged today. So yeah, it's mildly or slightly bearish as far as the market sentiment is concerned in the short term. It's a little bit more of a medium term issue as we see if it continues as we get the next forecast in February and so on and so forth. So is the OPEC Accord working? Yes, it is. Yes, it is. Without a doubt, it's working. Global inventories are coming down. Inventories in the United States are coming down. On January 16th, the March Brent contract actually went above $70 a barrel on an intraday basis. Didn't stay there, didn't hold, but it certainly was probing that area, and it was based on relatively positive market sentiment. Now, we've since traded off that level, and as of this morning, the March Brent contract is down to around 68.50, 68.60. So a slight pullback, and a pullback that makes sense based on the forecast that came out last week, makes sense based on the uncertainty associated with the U.S. government shutdown and if that's going to have any implications overall. But yes, the OPEC Accord is definitely still working. Further supporting that is inventories in the United States. Those total combined inventories are now down by 154 million barrels compared to the peak they hit in February of 2017. And now total inventories in the U.S. are only 37.6 million barrels above the 5-year average. This is through January 12th. We get a new snapshot on Wednesday. And right now, based on my inventory models, I'm expecting total combined stocks to decline again this coming week, and that 154 million barrel gap compared to the highs will widen a little bit further. Another element that's suggesting the accord is working, and it's going to probably continue to work at least in the short to medium term, is compliance to the deal is just historically high. Over the last 30 years, 40 years that I've been watching OPEC, they've never participated at this level of compliance to any kind of a production cut for this length of time. And all signs continue to suggest that not only will the OPEC members continue to abide by it, but certainly their main non-OPEC participants, especially Russia. Russia has been quite good in abiding by what they said they were going to do. And over the weekend and through this morning, just another positive comment. Now, the market's not really reacting too much to it, but it's something to look at. It's something to pay attention to. And the Saudi minister, and again, remember, when Saudi Arabia says something about OPEC or within OPEC, they hold a lot of sway within OPEC. So if Saudi Arabia is really pushing for something, they have a lot of convincing power associated with the organization, not only within OPEC, but also outside of OPEC with those non-OPEC countries that tend to participate in. So what Saudi Arabian oil minister said is we should not limit our efforts to 2018. So that's kind of saying, wow, this may go beyond 2018. And we have to be talking about a longer framework for our cooperation. Well, if you go back to the previous slide where we looked about U.S. production is continuing to rise, we look at the forecasts from the EIA and the IEA in particular that are projecting supply and demand balances to kind of move into a surplus during 2018, this becomes a very telling comment and one where the Saudis and OPEC are looking at those data, looking at those numbers, and what they're saying, the way I interpret that is what they're saying is not only do we have to maybe think about continuing this accord into 2019, but maybe we got to increase the magnitude of it. And this is going to be the discussions we're going to be seeing, circulating around the media airwaves. We're going to see some of these discussions coming from a lot of the private forecasters. So there's going to be a topic of discussion here in the coming months, and certainly depending on how the market digests that information, digest those comments, will certainly go a long way to setting the stage for what the market sentiment is going to be on a forward basis. On the external side, this happens to be a monthly chart of the U.S. dollar index traded on ICE. It's the U.S. dollar against seven major currency pairs. And you could see over the last, well, I don't know, year or so, it's been a pretty good correlation between the direction of the dollar falling, and oil prices rising. And we're kind of in this mode right now where one would think that the dollar would have turned around and maybe gone higher with the positive growth that's going on in the United States, with the massive tax cuts, both corporate and individual, that have taken place here in the United States for 2018 forward. Would kind of start thinking that the central bank might be getting a little bit more aggressive in raising interest rates, and thus being more supportive for the dollar. So far, we haven't seen that. So far, the combination of the U.S. economy still growing, but not out of control. The indications for inflation may be there down the road, but not so much yet. Not a lot of motivation for the U.S. central bank to really get very aggressive in raising interest rates, and as such, the dollar has not really gained a whole lot of strength. And now, coupled with the government shutdown, we have a little bit more pressure on the dollar here. And as I said before, that tends to be supportive of oil price. Not every day, but the trend is in that direction. And a falling dollar tends to be supportive for the entire commodity complex, including the oil markets. On the temperature forecast, this is the latest forecast that came out yesterday afternoon. We get these forecasts every day. The one on the left is for the 6 to 10 day period that takes us to the end of January, and the chart on the right here is the 8 to 14 day, which gets us into the first week of February. And as you can see here, the main heating oil region of the country, the eastern seaboard, is projected to be above normal temperatures for the next couple of weeks. So what does that mean? That means that heating oil demand is going to go down. That means there's going to be less upside potential here on the diesel side of the equation, unless, of course, we see a big increase in diesel exports, and or if we see refinery run rates decreasing faster than we anticipate for this time of the year. So overall, the weather is not very supportive, and it's one of the reasons why, as we saw in that earlier slide with diesel, it's kind of disjointing itself from the rest of the complex, and it's much more clearly in a short-term downtrend than either the crude oil or the gasoline at the moment. Okay, so where are we this week? It's going to be an exciting week, obviously. Every week of trading is exciting. There's going to be a lot of volatility. We have the government situation here in the United States. We have a bunch of the high-end people in most governments meeting in Davos starting this week. So we're going to get comments coming out of Davos that may or may not impact oil. Certainly it's going to be comments that may have implications by some of these various country leaders insofar as how they're looking at their economic growth in their countries, which ultimately could have implications on demand. OPEC, again, has clearly demonstrated, continues to demonstrate, that they're capable of working in this price-supporting model. There's no indications that they're ready to throw in the towel. There's no indications that, yeah, we got the prices up into the 60s, we're done, we're going to start increasing production. None of that exists. All signs continue to suggest that they're going to hold the ship steady. They're going to continue to keep production curtailed. And in fact, as I said before, the Saudis are going to start thinking about pushing the deal maybe further down the road, maybe even into 2019, and maybe at a greater magnitude. Obviously, there's a lot of variables that can change between now and then. most of those variables, though, are more towards the risk on the upside because a lot of the variables are associated with geopolitical events that are evolving in the Middle East. We're still having this proxy war going on between Saudis and Iranians in Yemen. We're certainly looking at the potential for the U.S. Doing something about the Iranian nuclear deal. There's obviously the ongoing situation with North Korea. So there's a lot of geopolitical events that are variables that could ultimately have a more upside effect. A big one that's continuing, and it seems to be getting worse every month, is the situation in Venezuela. Across 2017, Venezuela's production went down about 650,000 barrels a day. And is well below what they're allowed to produce under the OPEC cutting accord. And the situation in Venezuela is not getting any better. So it's conceivable that we could see production going down even further in Venezuela. So again, yes, there's risk to the downside, but I think there's a fair amount of risk to the upside here on the supply side of the equation. The market sentiment, although positive, the commitment of traders report still showing a large long position in the trading community, the hedge fund community, but that market sentiment got a little bit tattered last week with the IEA report, which, as I talked about before, which was a little bit on the bearish side. So we'll have to see how we evolve here in the short term. For now, for the medium term, I still see the market as being in an uptrend, although we may get some further corrections here. But I think overall, I still see an uptrend evolving. I still view the flat price market as look at opportunities to buy dips, especially when we get to key support areas that hold. I also recommend we use very tight trailing stops because you never know when we're going to get a sell-off. And it could be something nothing to do with oil. It could be a financial sell-off associated with what's going on in the United States or another country at this matter. So still positive, much more buy the dip type of environment. Again, lots of variables and unknowns related to the OPEC accord that could derail it. I don't see it happening, but we need to watch it closely. I'm standing aside on the diesel to gasoline spread. I just don't like what's happening on the heating fuel side of the ultra low sulfur diesel contract right now. And as we work our way towards the spring maintenance season, maybe I'm going to switch here a little bit and maybe be looking more towards a window of opportunity for entering into the long gasoline, short the diesel side of the equation. As far as the crack spreads are concerned, although they're still outperforming compared to last year, both the diesel crack spread in particular is basically much more of a downtrend. It's actually down to the lower end of its support. And the RBOB spread is in a wider downtrend, but it is towards the upper end of its trading channel. But overall, I think both these crack spreads have a bias to the downside. But I'm going to stay a little bit on the neutral side here. I don't feel comfortable shorting it at the moment. The weather can change, and that could put a spike on the diesel side of the crack spread, and the gasoline or the spring maintenance season is going to be coming up soon. We're going to be switching from winter grade gasoline to summer grade gasoline. So right now I'd like to sit, look, and analyze here a little bit and looking for a higher reward entry level for this particular type spreads. So overall, I think it's an exciting week. I hope you enjoyed the presentation. And I hope you have a very good week in trading or hedging or in analysis, whatever part of the market that you're currently involved in. Thank you for listening. And this is Dominick Chirichella. And you can email me at dchirichella@emi.org as shown in the front end of the presentation. Or you can actually call our company number to certainly get in touch with us all the way. Again, good luck for trading and have a great week.